Hi, good evening, everyone. It's a pleasure and an honor to be doing this today. I thank BCAS, Finance, Corporate, and Allied Laws Committee Study Circle to give this opportunity to me. Also, I thank everyone who is on call today for the time that they have pulled out from the busy schedule and who have come to understand some of the nuances of what is a REIT or an InvIT. I'll try my best to do justice to your time and share some valuable information. I am not a finance expert, nor do I claim so. So, pardon me if I say something which is not in line with your investment strategy. It may just be my perspective. The idea of this session is to share information on this investment product, how it operates, what does it offer, some bit of regulations surrounding it, because it is important to understand how a product is regulated. Tax treatment of this product for sure, and to answer a very critical question: who should ideally be considered? Who should ideally consider investing in REIT or InvIT? One is the timing, and second is whether you are the right kind of an investor for the product. I'll be overwhelmed if all of you have a better lens when you are evaluating the investment in REIT InvIT after this session. So without taking too much of everyone's time, let's flip through the presentation that I've prepared. I would request, if you have any questions, please send on the chat board. If I take a pause somewhere, I'll start answering all of them. I'll try my best to reply. If not, we'll have a Q&A at the end of the session and share, what we feel about this product, any questions which remain unanswered, and so forth. So I'm just not to scare anyone. This is a fairly detailed presentation. Ignore the table of contents. I'll go very fast on certain parts. So the first and foremost point for us to understand is why REIT, or where is the problem and what does a REIT really solve? Once we understand that, then we're able to understand what is this product, why this product is relevant for us. I'll just take a minute to explain where REIT fits in. What is the meaning of REIT first of all? REIT is real estate investment trust. So the name itself contains the word trust, and we'll dwell upon that in a matter. And InvIT is while it has got nothing to do with the jargon, but it is basically an infrastructure investment trust, but it's named as InvIT. It doesn't go in line with the same nomenclature. But let's take a scenario. What does the REIT solve? We know that we have real estate developers, and their expertise is to construct real estate. Typically, we can split real estate market into two: residential and commercial. So what is the difference? Residential mostly is a build to sell model, because the ideology is very simple. You should own a house. So the customer itself of a residential model is to own the house. So the real estate developer makes a property and sells it, and he gets his money and he's out of the project. On the other side, businesses, commercial estate, they are all built on a lease model, more likely than not. Meaning, a developer builds an office or a mall or a hotel, and then the idea is it should earn income from renting that floor space. If it's an office building, then it's office rental. If it's a mall, then shop rental. If it's a hotel, then keys. Now, this situation, commercial renting situation, creates a typical gap of funding for the real estate developer, which is called as a cash flow gap. When a real estate developer makes a commercial property, his entire funding may be backed up by investors, etc., or his own funds, is invested once the real estate comes in play. Then the return comes in form of rentals, which is generally not enough to cover the principal and the interest cost. So the real estate developer gets stretched in the funding. Further, in commercial renting, generally the real estate developer does not have the kind of expertise in finding the right high-grade tenants. You need to have a proper sales and marketing team, a proper team which brings you a good tenant. In a leasing market, the class of tenant determines the future of the property that is being leased. If you can make a fantastic commercial building and lease it to the wrong tenant, there's a high likelihood that the rest of the inventory will fail to reap the benefits. So in order to get a good tenant, the office building has to have excellent upkeep and maintenance, but the real estate developer struggles to do so. This gap which is there To bridge this gap, REIT comes to rescue. What is a REIT? A REIT is a structure where a real estate developer can make a commercial leased asset monetized faster and then give it an optimized financial gain. So this is what effectively a REIT does. Say a large builder, say ABC, has made a rental asset of 1,000 crores. That's the construction cost. It has started to earn 50 crores annual rent. Just an example. By this logic, the real estate developer earns a 5% return annually. Vis-a-vis what he can do and what REIT solves is the real estate developer can transfer this asset, and we are putting it in an SPV, a special purpose vehicle, into a REIT. Get units of the REITs and sell the units for say 500 crores to the public investors. He gets 500 crores and he settles his debt obligations or other obligations. On the other hand, the public shareholders get a rent generating asset, which will be professionally managed by a manager. So this gap is the gap with which REIT fills. This is just a very 50,000 feet view of how a REIT InvIT is supposed to work. It is supposed to bring commercial, or I would say rental generating assets being accessed by public at large. Now, having said that, what are the features of a REIT? A very crude analysis of what a REIT really brings into play. The first is fractional ownership. REIT effectively is fractional ownership to multiple people of hard assets. In my example, when we made a 500 crore worth of units being distributed to, let's say, 500 investors. Each investor had invested, let's say, 1 crore into the REIT. So he technically owns 0.1% of the assets of the REIT. So the most obvious question is that we have multiple models of fractional ownership using LLP structures where 10 people come together, they buy a villa, they buy a property that goes on rent, that everyone reaps the benefits. Everyone also getting, let's say, use or access to the properties. Then what is different? Why is REIT different? It's not comparable, first of all. This is not the market that REIT really caters to. REIT caters to large rental earning assets. When we go down, we'll see some real significant limits at which a REIT is supposed to be listed. So there is no direct benefit given to the unit holder. So investors for us, for example, the investors on this call, you will not get a direct benefit or access to the property under the REIT. It is fully regulated and dissected. However, the reason to mention fractional ownership is that your economic benefit of the unit that you will hold under the REIT is linked to the asset under the REIT. The asset is in the name of the REIT or the SPV. Moving on, the second feature of what a REIT solves is professional management. Now, categorically, professional management is something which a rental asset being put on lease for large MNCs or long-term tenants, correct, is rare in the current given situation. Now, the moment there is professional management, what happens? The asset life increases, correct? The class of tenants change. You have a long tenant occupancy rate, and accordingly, your business asset can start generating more and more income. So the REIT facilitates, and in fact, we'll go through a section where there is a regulation around having professional management around assets under REIT. The second thing which brings into place capital appreciation. So REIT does not just bring fractional ownership or professional management, it also gives access to the investors to earn on the capital appreciation of all the REIT assets which are there under the REIT. So you don't just live on rentals. If the asset is sold in future, you also reap the benefits of that. Regular income, one of the key criteria, and I would say this is the most interesting feature of REIT that you should all keep in mind. What does a REIT offer? Is a regular income. By law, and a REIT is SEBI-regulated REIT. So by law, it is required to distribute 90% of distributable proceeds on a regular basis to all the unit holders. Now, this is a mandatory requirement of a REIT. So this product that we are discussing right now will throw money as and when it has positive cash flows. There are certain exceptions which we can discuss, but fundamentally, it is supposed to distribute the earnings from the entire project or all the rental yields to the unit holders. The second last feature which I would like to highlight of a REIT is diversification. Today, when you are investing, let's say a crore of or 5 lakh rupees also into a REIT, it gets diversified into multiple assets across the country, probably across the globe as well. It's not locked into a single property. So a REIT can have a large SEZ unit in Bangalore. It can have a large hotel in Bombay. It can have a very large professionally an office building somewhere in Coimbatore. So your risk is diversified across geographies, across class of assets, across properties. Right? But one thing for sure I would like to highlight here is your entire risk is linked to the commercial rental earning asset or the sector. You are betting on this one specific sector. I will cover InvIT also. It's a little bit different, but let's focus on REIT. InvIT is something which you'll understand far faster. And the last is ease of liquidity. By law, all the REITs are required to be listed. If they don't get listed, there are certain provisions not to delist them or to liquidate them. But effectively, REITs are supposed to be listed and they can be traded like you have mutual funds. So, what does REIT solve for? What are the features of the REIT? We have covered these two. Let's now go to a typical REIT structure and why. Correct? Then you'll be able to understand how the product operates. I'll just use a pointer here. Can everybody, I'm hoping everybody can see my screen, but I'm going to use. So if you see on the left-hand side, there is a real estate group, a sponsor. So what is a sponsor? Sponsor effectively in a very plain vanilla structure is the real estate developer who has made the real estate asset and who contributes the asset to the trust, which is the real estate investment trust, in order to monetize the asset. Correct? So all simplicity said, real estate group or the sponsor is the sponsor of the trust. Unit holders are obviously the investors who invest money into the trust. The structure then calls for what is called as a professional manager. We just discussed a few minutes back that professional management is one of the key factor which comes with the REIT. So manager effectively is the key decision maker. Just like a mutual fund manager, in a similar manner, the REIT has a manager who is responsible for administering the REIT, identifying the assets, acquiring the assets, monetizing same, finding good tenants, maximizing the revenue of shareholders, and effectively, obviously, earning managerial fees by the use of assets. On the left-hand side, there is a trustee who is again required by law to ensure that all the protections which are available for the unit holders in terms of the structure, in terms of compliance with law, are duly undertaken. A part of this is also transferred to the manager in terms of responsibilities. So these two guys really take care of protection of investors. Further down, when you go, the REIT can invest in two forms largely. One, investment by what is called as a holding company structure. Basically, if you see in India, there is a huge difference in transfer of a real estate or immovable property versus transferring it when it is under a private limited company or a different entity. And the difference is obnoxious. Correct? Every time you transfer the property, you end up paying severe transaction cost. Now, in order to mitigate the transaction cost and not have the transaction cost again and again when the properties are sold or bought by REITs, REIT assets are sometimes parked in holding companies or special purpose vehicles, and the REIT holds such assets via these entities. If you don't have a holdco, you can directly have a special purpose vehicle, which is mostly a company, I would say. REITs can also hold assets directly. So it's not prohibited. REITs can hold it directly. It's possible. And important criteria is 80% of the assets of the REIT or the InvIT need to meet an eligible criteria. We'll cover that criteria in just next slide. But this is basically income generating assets. Rental income generating assets. So if you see the product itself is heavily linked to an income generating asset. The money that investors will put in will go for getting invested in rental income generating assets. there is a leeway given that 20% of the assets can go into under construction properties, projects, and debt and equity, along with nuances attached to it on how it can be used. This is a typical regulatory kind of a framework that I have depicted here. Let's also see what is the actual structure. How does this really look in real play, correct? I've just shown here the REIT structure of a very well-known REIT in the market called MBC REIT. This is available in public domain. So if you see, there are public shareholders in the REIT. There is a trustee. There is a sponsor. And all are these multiple SPVs, private limited companies, which are owning multiple properties underneath the REIT. All of these properties earn rental income and then send it to the shareholders or the unit holders. Now, further, this is an example of Mindspace REIT. Similar structure, manager, trustee, lot of private limited companies owning multiple properties, all shooting out rental incomes to the shareholders. The next example I would like to give is the Brookfield REIT. Pardon the diagram, this is what I could easily get from the public domain. But a similar structure, trustee, manager, trust, owns SPV. Now, so you understood the structure, you understood what the product caters to. Let's just go into the regulatory requirements of how the investment has to go in. And this is critical because when you are investing, you should know what kind of, where your money can and probably can go. For example, today, if I invest in a equity, I know it can go into any equity share of the company. If I put into a bond or debenture, I know it goes a debt into the company. In the similar manner, when we invest into a REIT, correct? What is it that the product really has in terms of protections or where the money goes? So SEBI has been kind enough to always lay down requirements like they have for the mutual fund managers, similar requirements for a REIT manager. So a REIT sponsor, for example, must hold at least 5% of the REIT units, even post IPO basis. So it's not that the real estate developer can just make the property completely monetize and go. In fact, there is a staggered way in which he can liquidate. There's also a net worth required for the sponsor. So SEBI wants that, large real estate players should make assets and then put them on REITs. They should have at least a 5-year of experience in development of REIT, real estate development, as well as fund management, both. One is being answerable to your own project. Second is being answerable to investors. You should have experience in both the sectors. Manager, that we discussed, who had the maximum amount of role to play in terms of how the REIT assets are to be managed. See, there's a requirement of a 10 crore of a net worth and 5 years of management history. In addition to the same, correct, SEBI has also mandated that all REITs must be registered with SEBI. All the REITs assets should be held under trust deed. There cannot be related party transactions. Whatever necessary resources are required for running should be kept under the manager and the trustee. And compliance to the board is mandatory. Any gap in all of this has got severe consequences. This you will find in almost all SEBI regulated products. However, in REITs, in order to protect investors, SEBI has also prescribed minimum norms on what the REIT should operate as. So these are actually operational norms. The REIT, whatever is in play, should earn at least 51% of income by rental and leasing activities, excluding property sales. This is a very critical point. Please note, the product that you're investing is not going to be a product which continuously trades in real estate. The product is essentially supposed to earn rental incomes. At least 51% has to be coming from rental incomes. Further, it has also mandated, and this is the point which I was discussing a few minutes back, that at least 90% of the distributable cash flows of the SPV must be passed on. So let's pause for here and understand that SEBI has mandated a product. Your money is going into a product which will compulsorily throw out 90% of the net distributable cash flows from the SPVs to the unit holders. So one thing is clear, it is not a product which will continuously reinvest money on an ongoing basis. There are provisions to reinvest. However, the idea of the product is to continuously throw back the earnings. So it's not a purely capital appreciating product. It is a product which is on the side of distributing dividends, if I may say so. Now, there is, like I said, reinvestment is allowed. So sales proceeds from properties or shares must be reinvested within a year, or they have to be distributed again. And there's a critical penalty levied on the manager that if the distributions are delayed, then they have to pay an interest at 15% per annum. So in a nutshell, the manager is supposed to invest into rental generating assets, 90% flow back to you guys, and reinvestment only within 1 year, otherwise again flow back. Plus asset allocation. When we test a mutual fund, when we test an equity, we always see where the money is going. Correct? We look at the asset allocation. How much is equity? How much is debt? Here it's very clear. Asset allocation is 80% of the asset in completed income generating properties with a lock-in of 3 years. Why there's a lock-in of 3 years? Very simple. They don't want to promote trading. Correct? You have an income generating asset, hold on to it, and then you can sell, and then the REIT can sell. Similar manner, up to 20%. It's a reverse cap. Up to 20% goes under construction properties, non-income generating properties, debt in real estate, mortgage-backed securities, again connected to real estate, and equity in real estate. So an important point for all of us to note is this product is heavily relying on the real estate sector of country or of the world, wherever it is. The money doesn't go largely beyond this sector. It stays here. And even in this sector, it largely goes in income generating sector. It doesn't go into passive capital appreciating assets. Smaller conditions as restrictions, which are maybe noteworthy to see, is conditions on asset allocation are reviewed every 6 months and non-compliance is addressed. So if the asset allocation is messed up for whatever reason, there's a method to flag it out. Completed rent generating assets must be held for 3 years. This is to stop trading. Second, and the third point is sales of property or shares exceeding 10% of REIT assets requires approval of unit holders. Now, this is a very onerous condition. So, if the REIT wants to liquidate 10% or more of its asset, it has to take unit holders approval, correct? Which has its own process issues, correct? And this demotivates the manager to, enter into more and more sale transactions. See, the idea is to have a 10-year, 15-year rental generating asset. And when the asset utilization or the asset is not getting rented, you will sell the asset in the market and appreciate the value and send the money back. That's the fundamental logic. Investments with others must not offer better terms. So what happens is when REIT invests into structures of layers of holding company and SPVs, it is mandatory and provided under law that nobody will get better protection as compared to REITs. Correct? So nobody can really downsell the investors, public investors. Now, smaller conditions, a little bit critical for everyone to just note. The mandate under SEBI regulation says that even if it's under an SPV, no shareholder partner prevents REIT compliances. So the REIT regulations percolate all the way down to the last level. The manager with trustee input appoints majority of the SPV's board. So the board remains in control. Even if I have less than 15% shareholding, the board remains in the REIT's control. And REIT voting rights are exercised in all the meetings. So these are all operational blocks. The holdco, very quickly, the REIT has to hold minimum 26% because as the law stands today, 26% is the number where a shareholder can do a lot of corporate blockages in companies. No other shareholder can prevent compliances of REIT. A majority of the board of the holdco is also appointed by REIT, and REIT voting rights are included in all AGMs. Other assets, properties, securities, and TDRs in India. Effectively, everything gets locked in real estate. So, product, where the money goes, protection of the money, how it is going to get invested, and the flow of money in terms of regulations. REIT, we have been talking about REIT for last 20 minutes. Now let me just give a quick recap on what's InvIT. a very quick comparative recap. We're not going to go too much of detail into it. The major difference between REIT and InvIT is the asset. As the name suggests, real estate investment trust and infra investment trust. So in the REIT structure, your money goes into rental generating assets. In an InvIT, it goes into infra projects which are going to give revenue over a very large period of time. For let's say a road project, which is a 14 years or 15-year tall project, which is a 15 years or 30 years of cash flows. Correct? So the money goes invested into such projects. Ports, for example, which requires a huge amount of investment. Correct? Again, so the money goes into these hard assets. SEBI has removed the requirement that 50% of the revenue should come from this project because of the gestation period. However, the requirement of throwing back the money of 90% on distributable cash flows still remains. So once the project is operationalized, once the project starts getting revenues on toll, once the port start getting access fees, the airport start getting its revenues, it should start throwing back the net distributable cash flows after all the interest cost to the unit holders. I'm going to quickly flip and show the important ones. Yes, the net worth criteria under InvITs are far more higher as compared to a REIT. There are 5 developers which come together, each putting 20 crores and making a 100 crore REIT. Here, an individual company has with a net worth of more than 100 crores can only make an InvIT. Similar requirement percolates all the way down for a 30-year total experience of managing infra assets and managing funds. So REIT is more onerous. REIT is of a much more higher scale, but in today's market there are very limited InvITs in place. In my view, they'll further come into play after 3 or 4 years once the success story of REIT hits. Investment conditions, again, no one can have higher rates than InvITs. The projects, if they are funded through Holdco, InvITs will hold 26% and all the boards will be appointed by the InvIT. And the other asset investment, again, infra, securities in India and public-private projects. Correct? So that is the sector where the money goes under InvIT. That takes care of the InvIT. Again, asset allocation remains the same. Now, this is where I want to spend some good amount of time. We have spent almost 15-20 minutes on understanding product, on understanding the regulations around it. We'll understand tax in a while because I have purposely put tax a little bit below because I don't want you to be convoluted by tax savings in a product. It's an investment product, and the idea is to share whether it's relevant to make investment or not. Tax is an outcome. Yes, you can compare the returns net of taxes, but let's first understand whether it's a smart investment choice or not. So how do you decide whether an investment choice is smart or it's not smart? I mean, what are the factors which really goes into decision making of an investment? So first is product. So we have understood that this is a unit interest. Technically, it can be shares in company as well, but for all the REITs which are in place, it is units interest. It is exactly equal to you owning units in a mutual fund. Correct? So product is clear. It's a similar product like you have a unit in mutual fund in terms of that look and feel. Regular income being distributed. So the regulations say you can distribute within 6 months. However, REITs and InvITs have been distributing income on a quarterly basis. That is a trend. Again, 90% of income gets distributed. So the product itself is not a product where money or capital gets reinvested continuously. It is a product where the product will continuously keep on growing rental incomes. Returns. The returns will be in form of interest, dividend, rental income, cap gains, and repayment of capital. Now, this is different. Please understand why I've brought this point here. When you invest in mutual fund, you get dividends on mutual fund, or when you send the mutual funds, you get capital gains. Here, there's a different mechanism being provided when you invest in REIT. So just right now, hold on your thoughts that we are getting returns in form of these 5 things. Commercially, everything totals up to the same thing, but this changes the taxation, and hence I've highlighted returns can be in the following forms. Fund utilization. Where is the money going? When you make a decision to invest in REIT, where is the money going? The money is going in income generating assets. Assets sourced are professionally managed, and to ensure stable and consistent income. So this is where the money is going to go. And is the risk involved? Uh, how is the risk being really catered down? Simple. Every 6 months, the REIT and InvITs are required to value their assets. They're required to be tested and checked, and there is a reporting done. So our asset class, asset quality, everything gets disclosed. Let's look at the return of this product. Now, I've made a very short comparative, and please don't hold me to it, but I've taken everything from public records. Let's look at what is the earning potential of this, of a REIT. And on the screen right now, you can see some of the most active REITs which are there in the market right now: Brookfield, Embassy, Mindspace, and Nexus. And the question first we need to answer is, do they fare better than bank FD rates? Now look at the yield. Look at the yield of 23, 7%, 6.7%, 7.9%. 24 yield is 6.97, 5.78, and 3.83. Now, if we just look at this chart, and we are comparing that in 23, the average yield was near 7%, and in 24, it dropped to 6%. So we can conclude this is very close to the bank FD rate. Why should I really bother about investing in such a product which is regulated, etc.? That's not a fair comparison. And because there are two more things to really compare. See, when the REITs were launched, the first REIT, Brookfield, the issue price was 275. Right now, the price has increased even after distributing continuous dividends or continuously yield. I would not say dividends, yield. Embassy was at 300, came to 362. Mindspace was at 275, became 371. Now, this is the current traded price. The price keeps on fluctuating. So you also need to appreciate that the asset is also throwing income in terms of increase in the value of the units that you have. So like your mutual fund giving dividends and again the NAV going up, in a similar manner, when you want to compare this product with a bank FD, at least the numbers which throw out, they are able to give a better return. So at least as per my analysis, do they give a better return than bank FD? Yes. But are they risky? Yes, they are risky because they are exposed to the real estate market. Bank FD is only linked to the banking sector or whatever rate being given by the banks. Next comparison, and the most asked question for in this forum is whether does it beat the stock market? That's the most common question, right? Now, to answer this, I have purposely put the last month so that I can show how important, to show an important behavior of this product. For the first slide, I'm just going to show BSE Sensex is the line which is moving here. Nifty Realty is the yellow line. Embassy Office REITs is the orange one. Mindspace REIT is the light blue one. And Power Grid is the move. Now, if you see this chart, this is just a 1 month movement, and as of cutoff of yesterday, right? If you see the 1 month movement, the most volatile line, at least, is the Nifty Realty. Nifty Realty is nothing but that comprises of real estate developer entities. In comparison to the same, where we have a downtrend in this orange Embassy REIT as of now, and even the Power Grid REIT. Sensex was almost flat, and Mindspace REIT was a little bit higher here. Correct? So that was a 1 month scenario. Now let's flip to a 6 month scenario. We go to a 6 month scenario and we see a different chart. Nifty Realty again has its own volatility. The Power Grid InvIT somehow is down 10%. However, Sensex and the Mindspace REIT are higher. This is a 6 month criteria. And we are very aware how the markets have functioned in the last 6 months. They have been volatile, they have been disruptive, and this is clearly seen in the charts. A 1 year scenario now shows where when you broad range your comparison, how it really looks like. So Nifty Realty was almost high as 35% at certain point in time. Whereas all the REIT lines, if you see, are not that volatile. They are in the range of 0 to 20%. And if I further broad range this is where you should understand the limitations of the product which we are discussing, which is REIT. If you see the REIT lines, the products which are under REIT are fairly flatlined. They are not as skewed as the market or the Nifty Realty. And the BSE Sensex has gone closer to 100%. Okay? What does this really mean? What does this really mean? If you see 5 years, BSE Sensex gave 84% return. And this is just a cutoff as of yesterday. Nifty Realty again high. Mindspace REIT high. Embassy REIT gave a lesser output. Power Grid gave a lesser output. This is purely the price of the unit. We are completely ignoring the rentals that it has thrown every quarter. So if you add that up, it will increase. However, even in the worst situation, the volatility here remains very less. It's -6, -18, -1.2, 4.8. Whereas here, the negative can be anything. So how do REIT InvIT fare against stock market index on a long range? Because the stock markets have performed better in the last 5 years post-COVID, the REITs are unable to meet that kind of a return. So product, restriction on the product, throwing out of capital gains, throwing out of regular income, protection to exposure towards real estate sector. Who is the ideal investor for the REIT? We are coming very close to answering the question for which we are discussing this product. Who are the ideal investors for this product? Steady income-seeking investors who want quarterly consistent returns, capital appreciation at the time of exit. So investors who want a flow of income on a regular basis, they do not want a gestation period. They want to have liquidity as well as flow of income. Built assets enthusiasts, meaning people who want to take exposure on real assets without the hassle of really managing properties, who want to really take a call on the real estate sector and that too of rental earning sector. We discussed at the start of the presentation that there is a diversification between what kind of rental earnings are there in a residential versus a commercial one. But here it's a commercial rental sector as of long-term investors. Long-term investors who want a steady growth over time and appreciation in tandem to the RE sector. Meaning, if everything goes bust, at least there is a hard asset underneath which can go for liquidity and still the money can come back. Principal protection to a certain extent backed up by assets. Risk averse investors, and do not get me wrong, this is not to pinpoint on any kind of investors, but there are certain investors or there are certain category of investors who can't take the full volatility of equity markets. You need to diversify. So they prefer a lower risk parameter to invest because they want protection on capital. And last but not the least, inclusion of real estate into the investment basket. So people, these are, in my view, a typical checklist of investors who should invest in a REIT and InvIT. If you are meeting these criteria, it's a fantastic product to really look out for. Now, whether this ideal investment strategy really apply to the REITs which are right now listed, let's look at that. This is a quick comparison of what is the unit holding of the REIT. If you see, Embassy REIT has most holding by FIIs, next by mutual funds, insurers, AIF. 15% is held by individuals, and few are still with the sponsors because there's a limit requirement for sponsors keeping it. Now these are all the FIIs. They need to diversify. They can't have complete exposure of the market, and hence they invest here. On the other side, Mindspace Business Park, and this was not something which I was knowing before. When I made this presentation, this was a revelation for me as well, that these two REITs have a complete different investor base as well. Mindspace still has 60% with sponsors, lot with FII, debt investment, DIIs, and a small portion with probably a negligible portion of investors. Correct. So those at some point in time when sponsor commits, sponsors will go down, probably the matrix will change. Now, quickly going into comparison between the products. Equity versus mutual fund versus REIT versus InvIT. Investment focus in equity and mutual fund is stock and direct ownership. REITs, real estate, InvIT, infra. Type of assets, broad range, REIT, commercial, InvIT, infra. Liquidity, high. REIT, once it is listed, it is high. And this is something which I want to park this with you. Once the REITs are listed, it is high. Once the InvITs are listed, it is high. If you try to invest before for any reason with the developers, you could probably end up in an unlisted scenario. Income generation, dividend and cap gains. Here, it can also have a flow in terms of interest, dividend, rent, cap gains, and other income. Similar to AIF, if some of you have invested via an AIF, in a real estate AIF, then you can probably get somewhere closer to that. Risk, the way in which you pick up the equity, it's business risk based on asset type. Here it's real estate market link and this is infra market link. Now, why should I not invest in a real estate rather than investing directly in REIT? Very simple. The returns on real estate could be higher, no doubts about it. Hands down, if you make a very good real estate investment, you can get higher returns as compared to REIT. I don't think that can be challenged, but that is a subject matter of finding the asset and then finding a buyer and selling it. Capital requirement here is intensive versus REIT is less. The mandated first offer for sale is 2 lakh. Liquidity high. Real estate relatively low because you have to find a buyer. Transaction cost for REIT is low for the investor because you end up getting listed units. Buying and selling of real estate properties has got a high cost. Diversification, very widespread diversification. You have asset class across geographies. You have real estate concentrated on one place. For whatever reason, if let's say that real estate is not able to get good tenants or good rental incomes, you're stuck with it. Professional management there in REIT, less likely in a owned property because you may not have that expertise or no, you may not have that kind of location or that kind of bandwidth to handle large events. This is just a there could be exceptions. People who find real estate properties which are very professionally managed, they can still crack it, but on a general basis. Control in real estate, you have a direct control on the real estate. Here you don't have control, it is via the REIT. Asset associated risk, very high in case of real estate. Here it is diversified, hence low. Hassle of management, and this is one of the biggest key reasons why a REIT could be successful is you are not connected with hassles of managing the real estate. People who invest in market, people who invest in stocks, people who invest in FDs, they don't have probably the time to really manage an asset. That's why they invest into digital assets, or I would say soft assets. Similar way, REIT removes that hassle, pushes it down to a professional manager, and you get returns. And tenancy related issues, while the regulations become much more simpler, they still persist in terms of your real estate. Here it's relatively less because the manager takes care of due diligence, manager takes care of legal, ensuring that the contracts are correct. Manager ensures that the property is protected and insured. So protection of asset is a very key objective of the manager. If you protect the asset, you will have a longer life to earn on rental incomes and gain more income out of it. Tax efficiency, I would say in a real estate, transaction cost is very high. Here, REIT, you can get better tax hit on sale of property. However, real estate, sometimes you can also claim better tax exemption on sale. So individual level, if you try to compare, it could become better as well. But this is when you compare a product at a very high level, I believe tax efficiency could be better in terms of a REIT. Lifespan of the asset relatively low. Because of this, relatively lifespan of the asset under REIT can be higher as compared to other manners. Again, exceptions could be there. Somebody can maintain the property at a very different level. Excellent. Last but not the least, the tax parameters. Now, so it's very important for understanding the taxation, how it happens. And there are largely 3 people who should really be affected by it. One is the real estate developer who really gives the asset to the REIT. Second is when the REIT earns income from rentals and pushes out to the investors. And third is when the REIT itself exits from the asset. Correct? 3 stages. First stage, and Income Tax Act has been streamlined over last 6 years to ensure that REIT is the most easiest and cleanest structure for attracting investments. And seldom there is a budget that I have seen in my career where REIT regulations are not streamlined and made more efficient. So as it stands today, when a real estate developer swaps the shares of the SPV with the units of REIT, it is exempt, and it is even exempt for the real estate developer. When the shares of the SPV are sold by the REIT, when the REIT exits, it is liable to pay long-term, short-term capital gains. Now, when the units of the REIT, so when the investor sells the asset, again, being listed shares, they can claim the long-term, short-term benefits. Let's look at tax implications on distributions. When interest is flown, now what happens is REITs can invest into SPVs by way of debt as well. It's not mandatory for it to invest purely in terms of equity. So when interest is flown from SPV all the way to the unit holders, the REIT does not pay tax. The law provides that SPV distribution of interest will be directly taxable in the hands of the investors. Now, this was made so that there is no double taxation at the REIT level. However, the implication of this is that income is taxable in the hands of unit holders as interest income. Now, interest income, unfortunately, is taxed at the maximum margin, at a slab rate which is applicable to the relevant investor. So, if an individual and you have income now more than 12 lakhs, that's a new threshold, you are taxed at a higher rate. If you're a corporate, this gets added to your income and you get taxed on the same. So, it sometimes does not have that same tax rate as compared to your long-term, short-term rates, which is 12.5% and 20%. Dividends coming from SPVs. So SPVs can upstream by way of interest. It can also send up dividends to the REIT. Dividends, well, they can be exempt in hands of the business trust. So they are passed through. However, the way it has been structured is if the SPV has opted for a low tax regime, it is taxable in hands of the investors. If the SPV has not opted for the low tax regime, it is paying full tax. Then it's tax-free for the investors. This is one avenue where probably investments coming from REITs are exempt, but effectively it is paid at the SPV level. Rental income from assets, like we discussed, probably business trusts can also own assets in their own name. So when a rent comes to the business trust, it is exempt for the business trust, but it is taxable in unit holders' hands. This is where this gets added to your normal income, because this is supposed to be a pass-through entity for that matter. Capital gains on sale of assets. So when business trusts will sell assets of shares of SPV, again, depending on their listed, not listed, long-term, short-term, your long-term, short-term gain is there, and when it's exempt in the hands of the unit holder once that money goes up. And any other income which is earned by the business trust, it is taxable at MMR. And if a tax is paid at business trust, this is tax-free. So in a nutshell, if you see, other than sale of shares of business trust for an investor, most things come at MMR. Rent comes at MMR, interest comes at MMR. Obviously, if dividend is taxed at a higher rate below, it is tax-free for you. So it's not a pure tax efficient product in a way in which if you want to compare it. I will probably not take you through a withholding tax section, but there's a section available where you can see how withholding tax happens, but it's only a cash flow. Interestingly, when units of REITs are sold, when there is a repayment of capital, so when business trust repays money in form of capital, this income, the Income Tax Act has pushed directly into other income, which is under section 56. I have mentioned technical sections so that you can refer. However, unfortunately, what has happened yesterday is the new Income Tax Act has come. All of these sections survive and they remain as is where is for the next 14 months, after which they'll get substituted by new sections. So Don't be surprised if these sections do not relate after 14 months. But the entire capital gain, the entire repayment of capital which comes from business trust is taxed as income from other sources. The corollary of this is there is a restriction on whether you can claim loss on REIT units. Nobody has tested till now, but once it is tested, we'll come to. So, key takeaways on what happens. Who should really, invest? The person who wants to allocate funds to a real estate sector, yes, a thumbs up for him. Those who want to diversify into less volatile sector as compared to equity, thumbs up for them as well. Those who want to have a consistent flow of return on investment, yes, this works. There are other multiple avenues available as well, but this also has that kind of a product linked to it. And those who want to invest in hard asset-backed securities, for whom it does not work, in my view. Those who want to invest in uncompounded return on capital. Let's say you want to put money into a product which earns which redeploys capital continuously and earns compounded return. This is not the product for it because it has an inherent limitation of sending the money to the unit holders. If you want to purely diversify, but if you put the entire money into rental assets, you're not going to diversify. This is going to put money into real estate sector. It is not going to diversify. If you put in mutual fund, it's going to diversify. If you put into mid cap funds, it's going to diversify across mid cap companies. This is going to put everything into a real estate sector. Those who want to derive value from business growth, not necessarily from assets. Again, not a investment product for them. And those who want to invest in a tax efficient product, I think this is not the most tax efficient product in the market. It has higher tax rate exposure as well. So REIT InvITs can be part of your portfolio for risk reduction and for having a steady cash flow. But I also feel in the current market, you should have a SWP, a withdrawal plan in equity if you want to balance out the low yield versus the equity risk. An important point which I also want to, one question which came before as we started this presentation, is that how do you evaluate which REIT and when to invest? Well, because the presentation I made, I pushed those slides a little bit down. This is how you evaluate, and this is how I would have evaluated. So this is the publicly available information on where is the embassy office REIT exposure really into. So if you see, it is maximum exposed to Bangalore. Now, if fundamentally you believe that Bangalore market has reached a saturation, then probably you may not get that much of money here. Whereas Mindspace, if you see, it has 40% in Mumbai region, 40% Hyderabad region. So this could be one of your investment making parameter on which REIT to invest. Okay. Second, this is also a critical way to evaluate. Now, this is also available in public forum. What is the million square feet managed by these all REITs? Now, these are completed square feet. Quarter one net operating income is likely to be 805 crores, 484 crores. Occupancy rate, this one. If you see, Mindspace has 90% occupancy rate, Embassy has 87%. So if you compare multiple REITs, you will figure out what is the occupancy rate. And when you see the average rent which these guys can charge, obviously it depends on market, because Brookfield and Embassy are in Bangalore, you have higher rentals. Mindspace is in Hyderabad, Split Bombay, you have lower rentals. And the average lease expiry which is left, the more this is, the more income the REIT will earn. Correct? So last but not the least, top 10 tenants percentage to total presence. And they have a method of really looking at what are the tenant percentages. So if you see, Brookfield Embassy has almost 1/3 plus as top 10 tenants, and Mindspace is a little bit short. So if you look at all these parameters, the geographical distribution of where these guys have made investment, you should be able to take a reasonable call on which REITs to invest. And on the timing on when to invest, whenever there's a fall in market, I think you should put some amount into REIT products. They are also now available in small case in your own basket. So you should ideally keep a bit of it under small case as well. I will push now to questions. to see if somebody has questions been posted. I'm not sure. I've not seen the Q&As, but let me see what are the pending ones, and then we can have a look at it. Any other questions that we have? I think, Raj, we can open the questionnaire or the mic for people to ask questions, and we can take them. Any questions which remain unanswered?
Yeah, two.
Okay.
Three actually. I'm answering.
We'll have a look at it. Sure.
So we'll be unmuting the participants. So those who want to ask the questions, they can. Yeah.
Harry, this is Anand. You can hear me?
Yes, Anand, I can hear you. Hi.
Yeah. Hi, Harry. Thank you for this session. Harry, I was investing, I started investing in InvIT, specifically power grid. But the day I started, it is continuously falling. I started when it was 110 rupee and today it reached 80 rupees. So the slide which you are shown earlier, so there I saw everywhere the current price is more than the issue price. But I don't know why the power grid is falling continuously when the asset base is very good. So what? And one more thing I want to understand: this distribution will stop any time, or it will be a perpetual distribution?
Answer. So, Anand, first question is, why is power grid falling?
Yes.
I think you will start seeing. So it's an InvIT, correct? So fundamentally, the gestation period of InvIT is very high, correct? When you have invested in InvIT, it will take at least, in my view, at least 3 or 4 years for the project to start throwing back money. Right now, it is paying off interest. The moment it crosses that threshold, it will start paying off to all the investors. So that's the reason why InvITs probably right now don't have a success story as of now, correct? But in long term, the way in which the economy is there, I don't think you should remove it. It should be there in your portfolio. But it is on a downtrend for sure. The second question, will it be a perpetual distribution of dividend? The answer is yes. The moment the InvIT or the REIT has positive distributable cash flows, it has to throw it out to you. There is no alternate available to them. And I see some, SEBI is more and more vigilant now. If there is a lacuna in implementing any of the given regulations, SEBI really goes down very hard on people, correct? And these we're talking about crores of investment and assets being managed of people. So I don't foresee that there'll be any relaxation on these rules. And when I look at the REIT and InvIT regulations internationally, this is the basic regulation which is there everywhere. Flow of money to investors is the key requirement under these regulations, and I don't think it will ever go away. It will remain.
Last one question, Harry. When I saw power grid InvIT, there is an additional component called dividend taxable, dividend exempt. And there is something called a treasury income. So this was not coming in the slide. That's the reason I just raised.
No, so dividend being taxable, meaning the SPV which has distributed dividend has claimed a lower tax regime. Now, if the SPV claimed a lower tax regime, it is taxable in hands of the investor, and the SPV has paid full tax on it, then that dividend is exempt to you. That's why you will see two different types of dividend income flowing. Okay. And what was the second question? Sorry.
Treasury income.
Treasury income. So that's a REIT. So let's say you have income earning, you have surplus money staying in InvIT, and you earn income out of it. So that's a REIT level income, which is tax paid at the InvIT or the REIT level and distributed to you exempt. So which is a kind of a miscellaneous income that you keep on earning because of excess funds and all of that.
Thank you. Thank you so much.
No problem.
We have one more question from Rohit Mansukhani. Please go ahead. Rohit Mansukhani.
Yes, sir.
Please unmute.
Yeah. Hi. So I just saw your presentation wherein you have made a distinction between REIT and the real estate. But at the end of the day, the underlying asset under the REIT is real estate only. So all the risks which are there under the real estate are also present in the REIT. Now, my limited question is, that whether REIT will give returns or not. My questions are not tax questions and all. So whether the
Sure.
REIT will give us a good yield or not would depend on at what price the asset has been dumped by the sponsor in the REIT, right? If let's say
Yes.
the case he has dumped the asset at a 7% yield, right, or 7% cap rate, and subsequently the yield is around 10%. Obviously, nobody's going to make money in it, right? And that's why I can see that the one of the mine space, if I'm not wrong, the yield was continuously declining. There could be two reasons. Number one, the pricing is high. Number two, that the occupancy or the occupancy is low. Rentals have fallen down. Particularly, I have seen their REIT, the majority of the assets in Navi Mumbai, which doesn't yield that kind of rates, right? And
Yes.
the capital appreciation will also be dependent on the underlying asset value. Real estate values are not increasing every day the way stock is increasing, and that's why when we make a comparison between the index or even the reality index, it will not show that kind of variability, right? And
Rohit, you are.
again,
Yeah. Yeah. Go on. Go on. Sorry. Go on. I thought the question was over. Sorry.
yeah, and again, if the asset has been dumped at a higher price, then again you cannot expect that kind of return. So, is there any norm by SEBI like that particularly on the asset dumping or asset transferring that uh, you understood my question, right? 7-10% kind of scenario.
I understood. I understood. So, see, Rohit, asset dumping when we say, correct?
Yeah.
Well, the REIT is supposed to take a proper valuation. Now, I will give the regulations and then we'll discuss the practical issues also around it. The REIT, when it acquires asset, correct, it is supposed to undertake a valuation from an independent reputed firm, correct, and then acquire the asset, correct. And these are all professional. The manager is supposed to substantiate why did they buy the asset at, let's say, 500 crores, and there is always there's a good branded report underneath it. So that's the process. So SEBI can only guideline, or it can write down the process to protect investors. Now, asset dumping, correct, if the sponsor is I would say sponsor, a real estate person is doing, correct. When you say, when if you're able to prove the same, Rohit, there are likely chances that SEBI will be able to interrogate and get it reversed. But to answer your question, very high possibility that there could be a short changing of public promoters. Uh, I would say for the start, they will not probably do this because they are wanting to. They also have to continue their stake in this same project, at least 25% for first 3 years, and then they can slow down. If the REIT does not perform, correct, their ability to put more assets goes down. So, for example, just to extrapolate your example, if you have put money into XYZ, I'm not going to name the REIT guy. You put money into an XYZ REIT and it is not giving money, and people have understood it dumping assets. If it comes out with an NFO, it will fail. It will come with an OFS, it will fail. Correct. So, I think transparency and parity to the public shareholders and those who take care of stakeholders will remain. There will be A class of REIT and there will be C class of REITs. And once we have a full-fledged 15-20 REITs out of it, you will be able to grade them. Probably, I'm just assuming there may be more regulations around violations for the public shareholders. But as of now, there is none. But it can come.
Yeah, but there may be multiple methods of valuation, right? I do a
So,
valuation, so you can play around. And if you're giving, regular rental, regular income, right, then nobody is going to complain. And that's why if you see there is no increase in the substantial increase in the returns of the REIT.
but
Why
Rohit,
and whenever,
when you see the value of the project, right? So any real estate rental earning asset has got a DCF, a discounted free cash flow of how the incomes will earn, and then there's an O&M contract. Now there could be also a situation where the operations and maintenance is also done by a related party or some other party as well. That is also possible. There are ways and means on which a fraud can be undertaken, but fundamentally, thus how much of such fraudulent REITs would be there in the market? I don't think there'll be a flood of REITs which are fraudulent. So if at the end terminal value the building is not earning any income, correct, the manager also not make severe money, good money out of it, and investor money to certain extent, at least the capital will come back, maybe at a lesser amount of return. It won't go zero at least. Same thing can happen in equity stocks also, right? When you list a company with a severe premium and it suddenly shoots down 60-70%, you lose capital. So it is linked to a sector, and there could be good players, there could be bad players, but yeah, that's the
Yeah, that I understand. My point was that there could be no, huge variability in either in the income or operating income or in the capital gains. Because first, if the
possible.
developer is doing a REIT, he will ensure that he makes money out of it, and he will sell at a lower yield. And then market norms may be different. Like as I said, 10% yield is going on. We may do it at 8 and 9% because nobody can question that. So that was the limited one.
Yeah, Rohit, point taken. The market-related risk, and this is a very colloquially known sector for all kind of frauds, right? Real estate sector is very well known for it. Correct? Probably these frauds can happen at a much more prevalent level when it's an individual asset. Title documents being fake, tenants taking over properties. All of those. The flip side of the story also remains as glorious as it is.
Thank you. Thank you.
No problem. Yeah, did we miss any questions on the chat?
Yeah, there is one more question, Nitin Mehta. Please
Yes,
get
Nitin, sir.
unmute and speak.
Hello, I am Nitin Mehta. What you explained regarding the power grid is in discount available, but in the same case, India grid is in a premium. So why the difference is there? Both are in power sector.
So I can check the relevant underlying assets and come back to you. I don't remember. Like I said, I'm not an expert into this, but I'll have to check the underlying asset and I can come back to you, sir.
Okay.
Maybe Raj, just give me his email ID. My team can just circle back on why there's a difference, and we can probably give a view on why it is positive and why it's negative. Nothing else.
Okay. Just my second question is, one thing I'm investing for last more than 3 to 4 years.
Okay.
Yield is very good, but one thing I'm not able to understand because I've read it is like a perpetual in nature. Correct. Now, just I'm not able to understand like uh, when I invest in a non-convertible debenture. In that case, my maturity period is fixed, and the
Yes.
company's principal is given back by company. Now, in
Right.
this case, like power sector, they are having 25, 30 years of concession period. Now, suppose let us assume that 25 years period is completed. Now, I will get my principal over the amount money back because
You will
this.
get.
Sorry.
Sorry. So I missed your question, but I heard till 25 years. Then can you just repeat that last part?
Huh. Now, suppose if I invested at 100 rupees, 150 or 140 rupees of India grid, correct? Now the concession period is said that 20 years, 25 years. Let us
Correct.
assume 25 years is completed. Then what I will get back?
So in a closing or a liquidation scenario, correct? The so logically speaking, it's a project, right? It'll be handed over to the government. Now you won't have any further concession remuneration coming from the government, correct? So I think it will stop giving dividends. But the money that it is accumulating or putting more money back into the other projects, I think other projects will start giving you money. Reinvestment will happen or distribution of income will happen. In a infra project, the project never is owned by the private owner. It is always given back to the government. If you make a road, for example, if you make a road, the road is then given to the state government. So your returns in case of infra projects are linked to the cash flows. In case the toll rates go high, in case power sector rates go high, that is where you can have an increased amount of distribution. That's my take on it, Nitin sir.
Okay, just one more question. Now, every time they uh, uh, they declare the NAV. Now,
Yes.
asset minus liability divided by number of units like this one. Now, on asset side, I'm considering the power sectors, India grid particularly. Now, assets, what they are considering, okay, what is the value of the ton of steel and aluminum and that scrap value. So, uh, I'm not able to miss how that assets. It is a gray area for me. I'm not able to understand this thing.
So you have to value your NAV based on an expert valuer and then give the NAV to the investors. That's how your NAV gets determined. It need not be the real value, correct? So let's say the steel prices go up and there is a stock available with the company. You multiply the steel price into stock available and then they'll compute the assets. Similarly, the other inventories and then they divide it. So while the NAV calculation really happens on a regulatory requirement basis, it may not be the right uh, value or the fair market value of that asset, if I may say so. It is only a mathematical measure to show what is your share in what is your NAV of your unit. That's it. But that has got very limited relevance, I would say. When you sell, at that point, your NAV may be XYZ, but if the price is high, you will be able to sell at a higher price. If there's a downsell in the market, even if NAV is high, you get a lower price. It's market dynamics.
Okay, okay. Thank you, sir. Thank you.
I think we have some questions online. Does rental income in hands of unit holder eligible 30% reduction? You replied that? We'll look at that. What are the so Prasad? I will reply to you. What are your views regarding investment in small REITs being allowed? So Hitesh, can I answer a question online? Can you hear me?
They can't. We are allowed to allow them. So you please go ahead.
Okay, I'll reply to them on the chat. Okay, this answer I'll reply on the
No,
chat.
you can answer on the.
Sure. So SM REITs, I would say, is a miniature version of REIT. So what happened is REITs have been here for several number of years, and if you see, there are only 4-5 listed REITs right now in the market. Lot of representations were made to SEBI that the size of REIT is such huge that developers are not really bringing more and more of this product to the market. So the SM REIT, if when we read the regulations, they are smaller size of a REIT versions which are coming. The sponsor threshold is lesser, and the size of the asset is lesser. So more and more of these SM REITs, once they list, you'll be able to see more and more of these REITs coming and getting floated in the market. The best comparative I can give is a full board IPO versus a SME. So SME IPO is a small size IPO that you really come out with of 10 crore, 25 crore, whereas a full board IPO is a very high sized IPO. SM REITs has a different regulations only under SEBI. Just to clarify, there's no distinction between income tax for the same. And my take on it is, if SM REITs start bringing really good returns, they can actually change the REIT market and acceptability. The smaller REITs are much more easier to get listed, much more easier to get investors, and will get better returns. So I am also looking forward to the success of SM REITs, frankly. Does rental in the hands of unit holder eligible 31 reduction? But if he only has one house, so there are restrictions on that. Yeah, that's what I'm saying. But we should also give the new 2-house regulation to him later on. So Prasad sir will reply to you because there is a amendment in the budget extending this to 2-house, and will reply to that.
Anyone has any questions? Please raise your hands. We'll unmute them.
And apologies if I'm hurting anybody's feelings, but this is my view. Hitesh is asking, what is the exit route for REIT investor? Sir, if you're getting good price on the market and if you want to invest in a better product, you can exit. And at the end of the story, logically speaking, if the REIT manager decides to liquidate the REIT, then he will sell all the assets, take your approval, because anything more than 10% requires your approval. He will take your approval, liquidate everything, distribute the proceeds to you. That's the exit route for REIT investors in the way it exists today.
So I think all the questions have been answered. So
If you have any more questions, you can ping me. Maybe Raj can give my email ID or LinkedIn ID, and you guys can ping me, and I'll be able to happy to answer them. Not a problem. It was a very good platform and an opportunity for me. I also dwelled down into a lot of subjects of REIT when I had to prepare for this presentation, frankly. Whether REIT is required to recognize gains as per market value of underlying assets. The regulations don't say that because it would tantamount to. So to answer your question, accounting wise, if there is a severe devaluation in the assets, then the accounting would impact and create a provision of that loss in the books. But increase in the value of the underlying asset, the accounting system generally does not allow recording of a non-realized gain. So it is always a conservative approach. So if your asset is downgraded, probably the accountant will want you to make a provision and take a hit in the books. But if it is a appreciation in the value of asset, it will only be recognized when you really sell the asset. That's how books of accounts are supposed to be prepared.
So thank you. Coming to the pleasant task of giving a vote of thanks. So on behalf of Bombay Chartered Accountants Society, the Finance Corporate Allied Laws Committee, and on my personal behalf and on behalf of all the participants present in this session, I would like to express gratitude to CA Hari Parikh for this very detailed presentation on REITs and InvITs as investment avenues. Your presentation was very detailed. I think even people who are new to this subject could very well understand and could take a lot of have a lot of takeaways to take back. And I would also like to thank Mr. Mayank Mistry, his colleague who was
Nice to see you.
hands-on at answering the question and answers. Yeah, thank you, Mayank, and yeah, thank you so much
Luck.
for giving such detailed answers in the question answer section.